silver just did something absolutely insane on December 12th, 2025. It hit a brand new all-time record high of 64.66 per ounce this morning, then crashed 3% to 61.70 in the same session. That's a $3 reversal in hours. And here's what's gonna blow your mind. Even after that violent drop, silver is still up over 100% year to date and sitting 5% higher for the week. So if you're asking, why did silver crash today? The surface answer is profit taking. But the real story, the one that mainstream financial media is completely missing, is what happens next. Because the same forces that just drove silver to a record high haven't disappeared. They've intensified. Let me set the stage for you. According to a breaking analysis published today on a major investing news site, silver opened Friday morning in New York at 64.47, hit that record of 64.66, and then proceeded to reverse sharply as traders locked in profits ahead of the weekend. Reuters attributed the move primarily to profit taking after the historic run, noting silver slid nearly 3% after touching that new peak. X Street echoed the same framing in their late-day technical update. Silver retreats from record high as investors lock in profits, describing a drop of more than 3% after the new all-time high. But here's the critical context that changes everything. Even after today's sell-off, silver is trading near record territory and remains up roughly 5% on the week, according to the same analysis. When an asset doubles in a single year and then pulls back 3% after making history, that's not a collapse, that's a breather, and the smart money knows it. So what actually caused the crash? There are 5 specific drivers, and you need to understand all of them because they tell you what's coming next. Number 1, profit taking. Silver didn't fall out of nowhere, it fell after making history. When you're up over 100% in a year, sell the rip behavior becomes common, especially heading into a weekend after a string of consecutive up days. Number 2, the US dollar stopped falling. Reuters noted the dollar held steady after falling in recent sessions. And that's a headwind for dollar-priced metals because silver becomes more expensive for non-US buyers. In a separate Reuters FX report from Friday, the dollar index rebounded to about 98.44 from a 2-month low. That bounce doesn't need to be huge to trigger a pullback when positioning is this stretched. Number 3, Treasury yields rose. Reuters Global Markets Wrap reported US 10-year yields climbing to around 4.86% as investors digested Fed commentary and mixed signals. Precious metals are non-yielding assets, so when bond yields rise, metals lose some relative appeal, especially after a big rally. And here's the kicker. Reuters highlighted that multiple Fed officials dissented on the most recent rate cut and voiced concern that inflation remains too high. That combination of slightly higher yields plus a less one-way Fed outlook hits silver harder than gold because silver is more volatile and more sensitive to swings in macro pricing. Number 4, risk-off spillover from tech and AI volatility. Friday wasn't just a silver story. Reuters reported major indexes falling sharply with tech shares under pressure and yields rising. FX Street tied the silver pullback directly to broader risk-off conditions, noting US stocks declined while yields climbed and AI bubble worries resurfaced. When equities get hit, traders sometimes reduce risk across portfolios, including trimming winner positions like silver to raise cash or rebalance exposure. And number 5, technical exhaustion. FX Street warned the rally looked overbought, citing RSI signals and bearish divergence as silver struggled to hold above 64. Another FX Street update described a bearish engulfing pattern and negative RSI divergence, flagging elevated near-term retracement risk. In plain English, after a vertical climb, stop losses and profit targets cluster. Once selling starts, the move can accelerate fast, especially in a market known for sharp percentage swings. Real quick, if you're still with me, hit that subscribe button right now. I'm tracking silver, gold, and macro chaos every single day, and the people who subscribe at this point always tell me 6 months later they're glad they did. Trust me on this one. Alright, let's keep going. Now here's where it gets really interesting. Even with Friday's pullback, the fundamental bull case for silver didn't just survive, it actually strengthened. Let me give you the facts. According to a detailed report published December 11th, silver just entered its 5th consecutive year of supply deficit. The 2025 World Silver Survey from the Silver Institute projects the global deficit in 2025 will persist, continuing a 5-year structural shortfall. Mine production remains flat at roughly 813 million ounces annually, the same as prior years. Recycling provides some additional supply, but not enough to close the gap. That persistent imbalance between supply and demand is what's underpinning the upward pressure on prices. One analyst quoted in that same report said silver is quietly outperforming gold because of structural deficit conditions and rising demand from renewable energy and industrial sectors. And get this, industrial fabrication hit a record in 2025, buoyed by strong demand from electronics, photovoltaics, solar panels, and green technology. But there's a new driver that just entered the equation in December: silver's addition to a US critical minerals list. Multiple reports today pointed to that development and the knock-on effects on supply chains and tariff expectations. That matters because it can incentivize inventory shifts, metal moving into US warehouses, and it complicates global availability. Both of those factors amplify price moves. And here's the angle that mainstream media is completely missing. AI and data centers are now part of the silver demand story. Business and market coverage in December has increasingly linked silver demand to the AI build-out, data centers, and electronics on top of EVs and solar. Michelle Schneider, chief market strategist at Market Gauge, told Kitco News in an interview published December 11th that tech companies are expected to spend $700 billion in capex building out AI infrastructure. But here's her exact quote: "That wouldn't happen if there isn't enough silver." Oh, think about that. $700 billion in AI infrastructure spending that cannot happen without silver. Schneider also said supply deficits have become a significant concern, and that demand is only going to grow while supply remains extremely limited. She told Kitco she sees silver hitting $75 an ounce in 2026, and that any consolidation or drop in price should be seen as a buying opportunity. Before we get to the targets and the plays, I need to know where you stand. Drop one word in the comments right now. Type 75 if you think Michelle Schneider's $75 target hits in 2026. Or type 100 if you think we're going all the way to BNP Paribas $100 forecast. I read every comment and it tells me what deep dive to do next. Drop that number right now. So where is silver actually headed? Let's talk targets. Bank of America just raised its 12-month silver target to 65 per ounce after real yields narrowed and ETF inflows strengthened. That's the conservative call. BNP Paribas is suggesting silver could climb as high as 100 per ounce by the end of 2026, as investors seek safe haven assets amid persistent inflation and geopolitical risks. And here's the technical picture from today. FX Street noted that even with the pullback, silver may test prior breakout zones around $59 to $60, and they emphasize that a retest can be constructive if it holds. Key support levels being watched right now are $61 as the near-term line in the sand, $60 as the psychological level, and $59.40 to $59.985 as the prior record high turn support zone. On the upside, FX Street framed $62 as a near-term pivot to watch after the drop, with resistance returning near the mid-64s if bulls regain control. And if momentum resumes, the next technical extension targets are $65, then higher. So what do you actually do with this information? Let's get tactical. If you're holding physical silver right now, do not panic sell into this 3% dip. This is exactly the kind of shakeout that happens before the next leg higher. If you don't own silver yet and you've been waiting for an entry, watch those support levels I just gave you. A pullback to $61, $60, or even $59 or $40 is your chance to get in before the next move. If you're looking at ETFs like SLV, same playbook. Wait for a retest of support before adding new positions. Set your alerts and be patient. If you want leverage and you're more aggressive, silver mining stocks are going to outperform if we break back above 64s and push towards 75. Look at names in the GDX or specific producers, but understand you're taking on operational risk and volatility that's even higher than the metal itself. And here's the risk you need to understand. If the US dollar suddenly reverses and rips higher, or if we get a surprise hawkish Fed pivot, silver could pull back harder in the short term. Industrial demand could also slow if companies find cheaper substitutes or reduce silver intensity due to higher prices. But the structural supply deficit is real, and supply responses like mine expansion and recycling lag behind price moves because mining and processing silver takes time. Let me bring this home. Silver hit a record high of 64.66 this morning, crashed 3% to 61.70 by afternoon, and is still up over 100% year to date. The sell-off was driven by profit taking, a firmer dollar, higher yields, risk-off spillover from tech, and technical exhaustion. But the fundamental bull case is stronger than ever. We're in the 5th consecutive year of supply deficit. Industrial demand is hitting records. AI infrastructure spending requires silver. The US just added silver to the critical minerals list. Bank of America sees $65. BNP Paribas sees $100 by end of 2026. Michelle Schneider told Kitco she sees $75 next year. Support is at $61, $60, and $59.40. Resistance is at $62 and mid-64s. If we hold those support levels, the next target is 65, then 75, then potentially triple digits. Next week brings US non-farm payrolls data, more Fed narrative, and risk appetite shifts tied to the AI trade. This is not over. This is just getting started. If this breakdown gave you clarity on what just happened with silver and where it's going next, smash that like button, subscribe to this channel, and turn on notifications so you catch the next move in real time. I'm tracking this market every single day, and when silver breaks $65, you're gonna want to be in the room. Thanks for watching, and I'll see you in the next one.